Janet Yellen went on to Good Morning America today and said you don't need to worry about a recession and you don't need to worry about high inflation. Janet Yellen is the Treasury Secretary of the United States of America, and what she said was, quote, "You don't have a recession when you have 500,000 jobs added in a month," which was how many jobs we added in January, "and we have the lowest unemployment rate in more than 50 years. And then she went on to say what she expects to happen in the coming months and year is that I see a path in which inflation is declining significantly and the economy is remaining strong. Now, this comes at a time where you have a lot of CEOs of companies that are acting and saying different things. Like today, Dell also announced layoffs. Dell announced that they're going to be laying off about 5% of their employees. It's about 6,500 people. And the vice chairman at Dell said that the reason why they're doing layoffs is because, quote, "What we know is that market conditions continue to erode with an uncertain future." So we have some opinions of CEOs saying, hey, we're seeing some big red flags in the economy based off of spending patterns, based off of what we're seeing in our business. And then you have the Treasury Secretary, the government, and the Federal Reserve Bank essentially saying, hey, you don't have anything to worry about. No recession, no inflation. What was interesting is when Janet Yellen was further pressed about why inflation is going down and how come we don't have anything to worry about, what she said was essentially that the government has passed a number of different programs which will bring inflation down, including things like the Inflation Reduction Act. Now, I think this is where it's very important to take a little bit of a step back and really understand what causes inflation, which will help you understand what direction inflation will go in the future. Because inflation at its core really comes down to the same thing, which is creating and spending money that you don't have. So the United States government gets its money from taxpayers through tax dollars. When you go to work to get paid, you pay a tax through your income. When you buy a home, you pay a tax. When you buy a car, you pay a tax. When you go and spend money at your grocery store, you pay a tax. When you sell a stock for a profit, you pay a tax. We pay a lot of taxes. Now these taxes go to the government, and then the government takes and collects these taxes, and then they can spend money. But now you might think that if the government generates, say, $1 billion in taxes, the most they'd be able to spend is $1 billion. But that's not how it works. See, the government doesn't run on a cash system. They run on a credit-based system. What that means is the government will take that $1 billion and then they will spend that $1 billion and then they'll spend even more through the help of debt. Now, this debt can be from people like you and me who buy treasury bonds. They can be from institutions who buy treasury bonds. They can be from governments who buy treasury bonds, like China is one of our biggest lenders along with Japan. And then it can be from another institution called the Federal Reserve Bank. So if you and I invest our money to the government, that's money that you and I have worked to earn. But if the government wants to spend a lot of money, say they want to spend trillions of dollars on a new plan, well, then they're going to need the money to do that from somewhere. How do you get the money to do that? Well, either the government can raise your taxes, or if they don't want to go through the legislative route to paying your taxes, and the next thing they can do is they can ask the Federal Reserve Bank to print the money and fund the bill. Now, if the Federal Reserve Bank is printing the money so the government can spend money, the first question is, well, what's the cost to that? Because if there was no cost to the Federal Reserve Bank printing money and funding the government spending, why do we have to pay taxes in the first place? And the answer to that is there is a tax. It's just a hidden tax. And the person who bears the burden of that tax is, well, regular people. When the government spends money they don't have, you have to still foot that bill through what I call the hidden tax. This is inflation. Inflation is now where the value of the dollar goes down, causing the price of things to go up. Now, this is something that we've been covering really daily on my YouTube channel and also Market Briefs, my free daily newsletter. If you haven't joined Market Briefs yet, it's a super simple and easy way for you to get a daily briefing of what's happening in the financial markets, the economy, the housing market, the stock market, crypto, and the global economy. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet and you want to stay up to date on what's happening, I'll put the link to how you can join Market Briefs for free down in the description below. So now, the government spends money they don't have. The Federal Reserve Bank prints the money out of thin air. They give it to the government. Now the government can spend the money. So the government spends money. This money enters the economic system. And the cost now is that the value of the dollar goes down, causing the price of things to go up. This is what inflation is. Inflation comes from the word inflate. What are you inflating when you have inflation? You're inflating the monetary supply. You're inflating the amount of money, the amount of dollars out there. So now it's kind of interesting that you have the Treasury Secretary saying that the reason why inflation is going down because of recent bills, spending bills passed by the government. So the government is spending more money, and because they're spending more money, that's going to cause inflation to go down. So kind of an interesting analysis or proposal that she said. But this is where now I want to kind of get you to understand the whole picture, because right now we got a very good jobs report. And because we got the good jobs report, that in a normal economy would be good news. But right now, the reason why you've been seeing the markets take this job report and sell is because you have a lot of traders saying, okay, if we have a strong jobs report, that means people are getting more jobs. If people are getting more jobs, they're demanding higher wages. If they're demanding higher wages, that pushes inflation prices higher. If people have higher wages, they're going to be willing to pay higher money for cars, for homes, for groceries. So they envision that to mean higher inflation, which then in turn means if the prices of things are rising because you still have a lot of demand, that gives the Federal Reserve Bank more fuel to raise interest rates more aggressively. If the Federal Reserve Bank is raising interest rates more aggressively, that has a downward effect on the economy. So they're playing like this chess game where you're looking at a strong jobs report and saying, oh, what could that mean? That means that inflation might be continuing to rise, which could give the Federal Reserve Bank more fuel to fight inflation by raising interest rates, and this inflation fight by raising interest rates has a downward effect on the economy and the stock market, at least in the short term. And this is where Jerome Powell, he's going to be speaking tomorrow. I'll be talking about whatever he says tomorrow. But in his most recent speech, when he raised interest rates by 0.25%, one of the things he talked about was the labor market, meaning the jobs market. And what he said was that we need a softening in the job market. Now, what that means in layman terms is we need more layoffs. We need less people to have jobs, because when you have all this strong demand in the job market, according to Jerome Powell, that raises wages. And when you raise wages, it increases people's spending power. Now, that might sound like a good thing, and it is in a normal economy, but what he's saying is when you increase spending power like this, that increases the demand for products. When you increase the demand for products, it causes the price of things to go up, which then contributes to higher inflation. So that's the problem that he's trying to fight. And now that we got the strong jobs report, which looks like good news, it can actually mean more bad news in the future, because then more higher interest rates. Now, I've been talking again about the cost of higher interest rates on my channel, which is, well, the cost of borrowing money going up. When the cost of borrowing money goes up, affordability goes down. Like if you want to go and buy a home, well, it's much less affordable to buy a $500,000 home at a 7% mortgage than it is at a 3% mortgage. So higher interest rates makes things more expensive, which makes them less affordable. Same with cars, same with general spending because of credit card debt. When people spend money on credit cards and interest rates go up, it makes your spending more expensive. Not to mention that our national debt, our almost $32 trillion worth of national debt, which is money that the government spend that they haven't earned. Well, the interest on this national debt isn't a fixed rate debt. It's variable interest rate, because treasury bonds are not always 30-year bonds. Some of them are 10 years, some of them are 5 years, some of them are 1 year, some of them are 3 months, which means that when the interest rate on that debt readjusts, the interest rate costs rise. And this has been a big worry for the government, and a big debate going on is what's going to happen as more and more of our debt payments readjust and we have higher payments on our debt. It's the same thing with corporations. We have the highest amount of corporate debt ever. And this corporate debt is not a 30-year fixed rate debt. So over the next 12 to 24 months, as more and more of this debt readjusts, you're going to see expenses rise. They're going to rise for corporations, they're going to rise for the government, and that's going to pose, well, some more economic struggles. And if revenues are not keeping up, this is revenues for the government in the form of tax dollars, revenues for companies in the form of revenue. If incomes are not keeping up with the higher expenses, that's going to put a lot of pressure on companies and governments to find an alternative solution. For companies, that could be layoffs. For the government, that could be cutting government spending. And so these are, well, that would be a good thing for the government. It's something that they need to do, but it's not something that they have done. So there's a lot of different pressures at play right now, where we have the government, the Federal Reserve Bank saying you have nothing to worry about. You have the CEOs of companies saying we have things to worry about. We're seeing issues in our businesses. And then you have everybody else who's just kind of walking down the system. And this is where I want you to be financially educated. That way you can take care of yourself no matter what happens, because there are a lot of red flags in our economy. And while things can look okay at certain points, I want you to be prepared for anything. Prepare for the best, prepare for the worst, and hope for the best. That's what it goes. But prepare for anything. That way, no matter what happens, you can always take care of yourself, you can take care of your family, and you can take care of your community.